Welcome to TrainFuture, where ambition meets expertise. At TrainFuture, we believe in the transformative power of mentorship and training. In this podcast series, I interview leaders and experts from various fields. Hi everyone, today's guest is Craig Palli. Craig has a decade worth of experience in startups, venture capital, and growth stage private equity. His most recent experience is at Companyon Ventures, where he serves as the venture partner, after working in various roles with Convergence and Common Angels. If you want to know more about Craig's background, I've shared the details in the description below. My first question to you today is, if you're a founder of an early stage tech startup, what is the main priority?
The really comes down to a question of product market fit. When you have product market fit, you then begin to invest in sales and marketing, right? Growth. Until you have product market fit, the vast majority of your resource and investment should go directly to finding product market fit. So this is truly understanding your various customer segments, understanding their usage cadence within each segment, and the value they derive from their usage cadence. Once you achieve those targets, that's an excellent time to begin investing in growth. But until such time, keep investing in the product, ensure that you're delivering great value to your customers, and ultimately you'll win.
It's interesting that you mentioned product market fit as the turning point. I mean, we've seen that play out with companies like Hex and Rewind AI. Both found initial traction, focused on user feedback, and then, only then, scaled marketing once usage metrics and retention demonstrated traction. Now, you've worked both across startups and more mature firms. From your perspective, what are the benefits of starting one's careers at a startup compared to a more structured organization?
I think the first aspect of the question that's really interesting is the pros and cons of a startup versus a more established firm to start one's career. To this, there's no right answer. What a more established firm offers is stability, structure, very defined training. If you thrive in that kind of environment, I would encourage you to go to work for the larger firm first, gain experience, gain expertise, and then if you want to do a startup, port that over to the startup culture and really think of your career holistically, not in terms of that first job, but in a 5 to 10 year chunk, right? That large established firm may be a really great place for you to get started. What a startup offers is visibility and practical hands-on experience at every single level of a company. You cannot get that in a large established firm. There's layers, there's bureaucracy, and there's established processes. So in the startup environment, you are drinking from the fire hose, you are learning on the go, and you're gaining tremendous insights and experience along the way, but at the risk of stability and structure, right? So if you're somebody who tends to wander, that may be a difficult environment for you. But if you're very focused, if you have that sort of innate and internal discipline, a startup can be a wonderful experience. Neither better nor worse, just different. And again, even if your first startup isn't your big home run, your big success story, it may be an important step in that journey to getting to that next company. And I think that's why both paths are so very viable and important for consideration. Now, when you think about exits, again, I would recommend that everyone think about their exits as a long-term endeavor. Maybe a student, a graduate of university this year gets lucky and they step into the right company at the exact right time, and in 12 to 24 months, they have a wonderful exit opportunity. It's an exciting experience. It can be life-changing. But for most people, that won't happen, right? But it may put them on a path to get there in the second or third venture that they're likely to join. So those are some considerations. Now we can get to the next part of the question is, well, what do exits look like? There are primarily three types of exits that can occur. There's the one that is in most news cycles, which is an IPO or selling your company to the public markets. The next type is a more traditional M&A type experience, which is you are selling 100% of the venture to another private company. And that has a very different kind of journey that comes with it because now you're giving control and leadership to a new entity. Then there's a third type, which is a PE exit. And a PE exit is you're not selling 100% of your company, you're essentially selling 51% of it and then marrying that private equity firm, which in essence is becoming the new management and leadership of the organization, but with a very symbiotic relationship to a leadership team that founded and grew a company. So these are three very different paths. All can be economically very rewarding, but they're just different ways of going about it. I think that each one of these opportunities brings unique insights and experiences to the team behind the venture. And I think all are viable and really do enrich somebody's growth and their own personal value that they're going to bring to the next organization. So once again, I think these are all excellent paths for somebody. The key is understanding the path you're on and understanding the pros and cons of each one so that you can make the decision that's right for your career.
I'm seeing a trend where early career firms like Perplexity, who joined when the headcount was under 20, and now they're raising their own micro funds or landing principal roles at VC firms. And speaking of that, a lot of our viewers actually want to break into venture capital or private equity. So, what's the most optimal way to land these roles, and what backgrounds and skills are most in demand?
You know, private equity and venture capital are more alike than different. And so let's recognize the private equity is generally a slightly larger or later stage VC company, generally with larger reserves and perhaps seeking bigger returns. So they're going after everything on steroids. So the path is generally VC first, although not necessarily. And when you look at the model of a VC or a private equity firm, it's important to consider the two main drivers of the business. There's capital recruitment and there's return on capital. So as any one of us as individuals, we have to say, which one of those drivers can we most add value to? Now, for most of us, we're not so well connected to the types of institutions that become limited partners in venture capital and private equity firms, right? We're not fundraisers per se. We don't know who to call to convince them to write a $10 million check that goes into a fund. So that puts most of us on the side of getting a return on capital. So now you can say, okay, what are the different means of driving returns on capital for a fund? And I think there's three primary aspects to this. There's the identification and landing of a venture, right? So who goes out and finds the next great venture and who convinces that venture to sign on to your firm by taking an investment from it and essentially selling a large piece, generally 20 to 50% of the organization. So that's an important role in venture capital. The next one is, once you've landed that investment, is who's going to help grow and scale what is now the venture or portfolio company so that it's prepared for exit. And then lastly, who is going to help drive and manage the exit, right? So we can lay out these different aspects of generating returns on capital. I think for most of us, as we seek to graduate from university or early in our career, I think the area we can generally most help is with the scaling of a company, right? So how do you get in there and really help the company get from its, say, initial user set to $1 million in ARR? And if you're at $1 million in ARR, how do you get that to $10 million in ARR? And I think the best way one can do that is to gain tremendous proficiency in a discipline that is important to a growing venture. So for example, if you are just a wonderful marketer, you understand marketing, you understand personas, people, drivers, and how to influence behavior, Focus on that deeply. Perhaps you become a great content generator that a VC firm can then leverage across its portfolio of companies to help improve their content generation across the board and really drive the user base up, right? That's of tremendous value. Perhaps you're a tremendous go-to-market architect. You know how to instruct tools like Clay and Puzzle and build them out together so that you can create a hyper-efficient customer acquisition program. Okay, that is something that's in deep need and value to every single startup. Develop those skills, bring it to the venture capital firm, and they will be your best friend. How do you break into venture capital? And if we go back to the framework that we talked about earlier, there's the identification and closing of promising startups, there's the growth of those startups, and there's the exiting of those startups. Okay, so for most of us graduating, we're really not the person that is going to write the S1 and drive the exit of the company. What we could do is we could be tremendous networkers and be somebody that is really well connected to a variety of startups. So some schools have dozens of promising startups being built right there on their campus. That's a great way to get connected. You can join the New England Venture Capital Association and you can learn about a whole bunch of startups that way. And if you could be a resource to a venture capitalist where you can say, hey, I can every week deliver you a really interesting company that's worth you taking a look at, that is a skill set that a venture capitalist would be highly interested in hiring over time. Another way you can do it is to become a deep expert in a discipline that's important to a venture capitalist. So again, become an expert marketer, become an expert go-to-marketer who can align the tools, the HubSpots, the Clays of the world, and really create a super efficient customer acquisition process. If you can do that, if you can blog about it, if you can write about it, you can demonstrate that expertise, again, you become a highly valuable resource to a firm that would potentially want to hire you. And ultimately what this comes down to, though, is building a great network. For any person who's graduating near term, think of the network that you've started to build through university, and the network that you're going to build over the next 5 years is your most valuable asset. Because over time, you're all going to grow together. Some people will join venture capital funds. Some people will join startups. Some people will join larger entities. But you're all ultimately going to be customers of one another. You're all going to find a way to partner with one another. And having that deep-rooted network of experiences and trust and credibility amongst each other is the most valuable thing you could ever generate, and it will provide returns not just over the next 12 and 24 months, but over the next 12, 24 years. So really take a long-term view to that. So the simple answer to your question is become an expert and build your network. That will benefit you regardless of your career path. If you want to work for a VC firm, become an expert and expose yourself to VC firms. Again, New England Venture Capital Association, identify a firm that you'd like to work at, go introduce yourself to that great woman at the VC firm and make friends and really show them that you can deliver a lot of value. Likewise, if you want to be a part of the startup community, connect with a lot of founders at these kinds of meetups. And again, demonstrate that you have expertise in a given area that's of value to them. Those doors will open. We see it every single year. I remember how early in my career, how people were receptive to gaining advice and insight from a level of expertise. And that is a pervasive trend that will always exist. If you can add value, people are going to want to associate with that value and find a way to come together in a meaningful business relationship.
I like how you mentioned value creation over pedigree. At the junior level, I'm seeing analysts with deep op experience at companies like Ramp or Notion that are getting into fast track growth equity roles, specifically because they understand GTM mechanics and not just how to build pitch decks. So that brings me to my next question, which is how important are financial modeling and Excel skills for founders or even someone trying to break into venture capital?
Everyone benefits from having strong Excel and modeling skills. Every single startup has a detailed spreadsheet, which essentially manages cash, projects profits and losses, and really figures out how much runway you have to run your business. So this is an incredibly important tool. It is required to run a business, and venture capital firms aggregate these tools across their portfolio to sort of have deep insight as to the performance of their funds. So it is important to have a level of Excel skill. That all said, when you get into sort of extreme modeling behaviors, right, where you're actually coding cells, the average entrepreneur does not need to focus on that. I think you can hire that skill if you need it. I don't believe that most do. The venture capital firm themselves may have that kind of a resource on staff. And I think that we're going to find here in the coming months that there's going to be plenty of AI-enabled tools to help develop those models. For the near term, I think what's most important is, again, focusing on developing an awesome product that delivers tremendous value and having a great relationship with your customers. Those things will always eclipse the importance of modeling. So if I were to spend my time on any one thing, it would be much more on the value creation side through product and customers than modeling. That said, let's not sleep on modeling because we need it. All I'm suggesting is if you can do the basics of Excel, if you can run out some basic forecasting, you'll get what you need, certainly in the earlier stages of a company. And then when that more complex modeling is required, say after you're at $10 million in ARR and you want to do sensitivity analysis on things, those tools and resources will be readily available to you.
Absolutely agreed. I mean, founders are expected to have a firm understanding of revenue drivers, core performance, and cash burn. And for VCs are asking for scenario plans, not just static projections. So modeling is equally important. But beyond Excel, what are the most critical technical or analytical skills for someone who wants to break into venture capital, private equity, or even build their own startup?
I think it really comes down to data science. Being able to look at large data sets, being able to understand the meaning and surface the important learnings from those data sets is where it's really at. And I think that once again, we're in a really interesting time in our lives where we can actually take such spreadsheets or large data models and feed it into tools, whether it's a chat GPT or otherwise, and start to gain some insights from them. I think it's really exciting to think about our world where we can sort of level up our own game in the areas where we may be stronger or weaker using these kinds of tools as enhancement and enrichment. But I think the short answer is the most important technical skill, if you will, is understanding how to look at a table, how to look at data, how to look at trends, and then most importantly, from those trends, identify where there's opportunity to gain value.
I definitely agree. And I'm seeing funds that are using tools like Hex and Omni to analyze portfolio performance and total addressable market validation. And often, like in-house before the term sheet goes out. I mean, speaking of that, like we're seeing an increasing number of tools, like especially now with AI. So like OpenAI and DeepSeek, how much of the traditional venture capital or private equity workflow can be automated? And how should investors and founders be adapting their workflows to leverage these tools?
So AI in its current state is really about creating tremendous gains in efficiency, right? How do we create superhuman levels of productivity? Think Tony Stark Iron Man, right? Taking the best of the best, taking a really smart person and then empowering them with tools that they couldn't have dreamed of to accomplish tremendous tasks. And this is what AI is doing today. It is gaining our productivity, our speed, and our quality of our output at incredibly rapid rates. So some examples of this, if you're the management of a startup, right? So you're the founder or the leader of a startup. Perhaps in the early days, you thought you needed 4 developers to code. And now using Claude, you can get that same productivity out of 2 developers. You've just created 2 superhuman developers, AKA Iron Men or women, using a tool like Claude. Now let's say you've built your product, you're really happy where it sits, you've found product market fit, and you say, okay, it's time for growth. So now using tools like Letterbox and Clay and Puzzle, you can engineer an AI-driven go-to-market scheme where all of a sudden you can get the productivity of 3 or 4 marketers with 1 person and have a really rock solid go-to-market plan that is just running itself, and you can sort of manage the data and see the value of your pipelines grow because you've modeled this out using AI. So in both cases, what we've done is we've enhanced the productivity of a professional 2x. And I do believe that the tools exist today to enable that multiple, and that multiple is just going to grow over time. Okay. In the same regard, venture capital firms are using these same tools, but in different regards. So for example, you might feed a legal document into, or a term sheet into ChatGPT, and you may ask ChatGPT to sort of review that document and share thoughts and look for holes, look for what's good, what's bad. It's a productivity increase. Larger firms will get more and more complex. I believe ultimately PE firms will have very large advanced AI tools that analyze markets and solutions within those markets to create value. Today, that's not happening. Certainly in the smaller firms, it's much more of the how do we make more efficient our legal, accounting, and basic operations of a firm. But it's incredibly exciting because we see this happening on both sides of the funding equation, both with the venture capitalists and the startups themselves. I believe in the early days, the startups right now are the bigger winners because I think there's more productivity to be gained there. But ultimately, everyone's going to benefit because there's going to be more leverage from every venture capital dollar invested into these startups. They can stretch them further, achieve more milestones, and ultimately create more runway.
Some AI companies are leveraging the current hype cycle to go public, to seek high IPO or seek strategic exits. Others are facing investor skepticism. So how do you see founders navigating this decision to go public versus staying private in this AI boom period?
It really depends on your access to capital. If you can be OpenAI with seemingly unlimited access to capital, I mean, there's this whole consortium now with the U.S. government and Oracle where $500 billion is going to get invested in Stargate, and we're going to build huge data centers in Texas, right? We're really talking about an unlimited amount of capital. So in that regard, it is wise for OpenAI to stay public in the near term because there's less scrutiny. They have more flexibility between their board and the leadership team as to what they're going to build, how they're going to build, what they're going to prioritize without having to worry about profits and revenue growth in cost centers. As soon as we go into the public markets, there's more scrutiny, there's more rules, and it's not as expeditious to develop your firm in most cases. However, if you don't have access to capital, or you don't have access to hundreds of millions or billions of dollars in private capital, then an IPO is a great path to raising that capital. And again, you'll have the right structure to make sure that you're building the company in the right way because you have the oversight of the public markets. And I think what you'll probably see in the nearer term is maybe you'll see some more focused and more vertically oriented companies have successful IPOs in the AI space because they're a little bit more defined and they don't need to sort of branch out and investigate how they want to build their business quite the same way that some of these larger entities that are looking for more general use cases are looking to build out. So we could see an evolution in that regard. Once again, we're still in early days, but we will see a mixture. We will certainly see a mixture of companies that raise significant capital in private markets, and we'll see many more that go public. And we'll see how this plays out. Once again, we saw this in the early days of the automobile industry. We saw it again in the early rise of the internet and mobile, and now we're seeing it in AI.
That makes sense. I mean, companies are sitting in the stage where they have enough traction to go public, but also enough capital to delay it. My last question for you today is, what are the most useful college courses or subjects for someone wanting to break into venture capital, private equity, or even a startup route?
So I would break this down into a few different areas. One, any sort of product related class where we can really think about the discipline of how do you conceptualize an idea, how do you bring that idea to fruition, and ultimately how do you ship a product. So anything that's focusing on the phases of product development is incredibly valuable, especially in terms of being a founder of a startup. I think the next area that becomes really important is sales and marketing. And sales and marketing is where you take that product and you demonstrate its value to your ideal customer profile. And what I think we should all recognize is there's lots of wonderful products in the world today that never got the traction or value that they deserve because we didn't know how to market them. It happens all the time. So don't discount the importance of selling that product, even in the world of tremendous product market fit. I think the other thing that's not often appreciated enough about sales and marketing skills is the same skills that will allow you to be successful marketing your product are the skills that will allow you to be successful in marketing your company to the venture capitalists who will fund it so you can then grow that company in the first place. So it's truly about understanding the empathy of the person you're speaking with or the audience that you're speaking with, understanding how to position what you're offering in terms of what the audience values. And so these are skills that will permeate all aspects of your life, certainly your professional career. So the product, the sales and marketing classes, I think are incredibly important. And then finally, the financial skills to manage it all, right? So this is the operational aspect of it. The basic accounting, the basic financial modeling that you need to run a business. If you can have those three things, right? The ability to create a product, the ability to sell a product, and the ability to sort of manage the operation such that you can watch your cash flows, you're going to be successful. Those are the foundations.
Craig, thank you so much for your time. It was a pleasure having you. Your responses were, incredibly valuable, and I'm sure our viewers will love it. Thank you. Bye.
It was a lot of fun. Thanks so much.
Thanks so much.